Welcome back to the channel, guys. Really just want to do a follow-up video from my last video talking about, the steps of, starting your investing journey, of what type of accounts you had to open up and how you should be allocating your funds. Like I said in the video, I said, in my opinion, for beginners, you should do 80% ETFs and 20% smaller bets. And that's being, if you want to dabble into crypto, I would say do anywhere from 3 to 5%. And if you're going to do individual stocks, 15%. But if you're not going to do crypto because you just don't like the idea of crypto, I would do 80%. 80% of your cash should be going to ETFs, and then 20% going to individual companies that you feel confident in. But it's up to you guys, however you guys want to do it. Maybe you don't want to do ETFs because you think ETFs are too boring, or you just want to do individual companies because it's better returns, right? So this video, I really want to talk to you guys more about how to invest, right? Because I did tell you how, but like as a beginner, like when to buy if you want to start off doing these ETFs, when to buy and why you're buying, right? And the reason we're going to talk about bear markets today is because those are the greatest times to buy, right? And I'm using the S&P 500 as a great example because this is what people use as a benchmark, and what's going on in the market. So it's really important to understand what's going on in the SPY, the S&P 500. And the reason why you should look into bear markets because you need to understand the opportunities of bear markets, right? Imagine you being able to buy the ETFs at these prices. It would be giving you, ridiculous returns, right? And, you could look back and do your research and see how long it took. Like this one in 87, it was in 87, it was the Black Monday. Black Monday. Look into it. How long did it take? You could see it was in 87 and we didn't get to the highs in 2 years, right? So it took 2 years to really, get to a record high, get back to new highs. And it's really something that we haven't seen. Like we have never been in, well, not say that we haven't, but in my time of investing, I've been spoiled. And I understand that I've been spoiled because I did start investing before COVID. I did start investing before COVID. Give me 1 second. I can't believe I'm having trouble finding it. I think it's this one right here. Yep. Right. As I started investing before COVID, and I really wasn't hit with a bear market like that, right? Like if you look, you didn't really have you had the last crazy bear market we had before COVID was the crash in 2007, the global financial crisis, right? And then you had the dot-com bubble. And really after those two, right, you didn't have anything crazy. If you look, you had these dips up here. You had 2018, the sell-off. But if you look around these times, the market recovered extremely quickly, like extremely quickly. Like it didn't take the market 2 years to get back to all-time highs. During COVID, it took a few months. You see, in 2 months, we went down like 30+%. I think we went maybe 33% down from the highs, and then in a few months we broke those record highs and just continue going forward. Then after that, we did have that bear market, the first bear market that I experienced. That the market ended in a red year, right? And that was a great opportunity to be buying stocks. Like imagine if you was just buying stocks throughout this whole time, right? In 2022. And then look where we are now. It's, that's why I love bear markets. And I always recommend people to study bear markets. Study how long it took us to get out of a bear market. What was the factors that helped us get out of the bear market? Like I love doing that type of research because bear markets should be, your best friends. This is where opportunity is bought. Not up here. You don't want to buy. You don't want to buy up here. You want to buy down here. And if you do your research historically, buying when the market is down is the best time to buy, and that's the only time I buy. We've just been very spoiled in the recent bear markets, right? That we really haven't, like this one right here. Like we was down for 20%. This was like the tariffs. And look, like we was there, we was only down for like 2 months, and then boom, we just continue going higher. And then we had this. What was this? 2026. Huh? I don't remember this little dip. What was this dip? I can't remember. I can't remember what this dip was, but I'm pretty sure I bought it. Whatever it was, I'm pretty sure I bought it. But this is like, you should be studying these things, guys. Like, this is what you should be studying, right? These are the times you want to buy, right? It's all about patience, right? I made a video talking about Warren Buffett, right? Warren Buffett is one of my favorite investors of all time. And he's not nothing special, right? And that's why I love investing too. You don't have to be born with any type of special trait. It's all really instinct and your understanding of like, everybody's fair. It's like, this is truly like the only place I believe that it's like equal game, right? Anybody can make it. Anybody can make it. And that's why I love it. So, boom, when you look at Warren Buffett, like, his thing is not, it's not like he had some type of secret strategy that just made him be profitable every year. All he did was buy and hold. His game was being patient, right? And you just have to be patient, right? You just have to be patient. And that's your greatest ability. If you could be patient, that's why it's always good to invest with money that you don't need the money to do your day-to-day things. If you can invest 10, 20, $50,000, and be okay if it goes down for a year or if it goes down for a few months, right? And you could see it, if you have a long-term approach with this, you're going to be fine, right? Even if we go into a crazy bear market and it takes us, for example, I think is this one too, the dot-com bubble. It took, for us to, break the highs, it took 5 years, right? Would you be able to buy down here and wait? I know I could, but could you? Could you do it? Could you wait? Could you be buying down here, right? Understanding the history of the stock market and continue to buy, because sometimes it doesn't always work that you buy down here in a couple of months it just goes back up. A lot of times you'll be buying here, it'll go up for a little bit and then it'll go down lower. And that's when you need to understand, like, you need to be strong. You need to understand, like, it's a long-term game. You buy now and you'll reap the rewards in the future, right? Based historically speaking, right? It's the best time. These are the best time to be buying, right? And I say it all the time is you have to be patient. When I was buying at these dips, I what I would do is, because red is very triggering. Green is easy for us to see. I swear there has to be like some type of like psychological game that they're playing with us. That's why they show our P&L in red and green. But like, one of the things you have to, like, what I do, right? If we're in a bear market, what I do is I invest my money, right? And I just uninstall the app. So I'm not even looking at my investments. And the only time I'll ever look at my investment is when I'm going to buy more. Like, if I see that the SPY's going down, I'll just go in there, buy more, and then I'll just delete the app again. But that's just something I do because I understand that, seeing your account red could be frustrating, right? Seeing it could be frustrating, but if I don't see it, I know I'm gonna be good. So that's something I do. So I don't know if that could help anybody in the future. But like I said, last video I talked to you guys about like how like I said, how you should start investing. 80% ETFs, 20%, individual companies. And I'll talk to you guys about that too. But one of the easiest way, right? This is how you should be investing as a beginner. I'll pull up a daily chart. Remember, in my opinion, right, you should always be buying the market. If the market's down 5%, you should deploy, whatever you think is the appropriate amount. I always say anywhere from 10 to 20% of your portfolio should go into the market if it does a 5%. And 5% is basically 5% from the highs. So where is that thing at? Okay, over here. Let's say, for example, right, you're just going to measure, right, let's say this high. This is the high, right? You're going to measure this. And wherever 5% is, you're buying. So basically, you'll be buying here. 5%. If it drops 10%, you're buying more. If it drops 15%, I like to do, rules of fives. So every 5% decrease, I'm going to buy. Right? I'm going to buy. That's just the way I do it. I'm going to buy. And that's how you should be investing, right? And then you could go look, you do your little history, go check how long did it take the market to recover after a 5% pullback, because technically speaking, that's what they would consider a pullback, 5%. And a lot of times, that 5% pullback in price is just basically people taking profit, or whatever they call it, sometime a market breath, whatever like what people like to call. And it's good to learn like those skills. Like, it's okay. Like I said, I never recommend anybody to day trade or swing trade. I think you should just buy and be a long-term, investor. However, it doesn't hurt to understand what a pullback is, and technical levels, the 200 moving average, and all that crazy stuff that they like to think of. It's nothing wrong with understanding those indicators, because those indicators play a part in, they're a part of market psychology, understanding like a flag pattern, all that crazy stuff that people like to think, like, a little flag pattern. Well, what's a flag? What's a flag? Oh, somebody might have been saying, oh, yo, look, there, it's flagging right there. We're gonna get a breakout around this level, and this is where we should be buying. Maybe somebody said that. Maybe. I don't know. I don't believe in stuff like. Well, I used to believe in stuff like that, but not no more. But yeah, you should be an investor. That's how you should invest if you're a beginner. Individual companies. The reason why that strategy might not work for like individual companies, and I'll pull it up. For example, which one is a stock that's been beat up and is, in my opinion, is a really good stock? Adobe. There you are. The reason that wouldn't work like with individual companies is because individual companies, right? They could drop a lot more than 30%, right? They could drop a lot more. And sometimes, like in the case of Adobe, right? And this is the reason you need to be patient, right? This is the reason you need to be patient, and you need to understand when you're investing in these companies, right? The broader market, the reason I like ETFs is because you really never gonna, like, I really truly don't believe that we're ever gonna see the market go, drop 50%. Could it happen? Yes, but it's very unlikely. Like, what's going on in the world that the market would drop 50%? 50% is pretty crazy. However, you could see a company like Apple, Microsoft. You could see a company like these drop. Very unlikely, but you could see them drop 40% from their highs. Like Adobe. Adobe is a great company. Adobe, the only reason Adobe is dropping, there's nothing wrong with their earnings. There's nothing wrong with the the projections. I think they're projected to grow 9 or 10% for the next 10 years, right? They're making a lot of money. This is maybe one of the cheapest companies in the stock market, but it's all about narrative. That's the only thing I don't like about individual companies, because you could research a company like Adobe, and based off of the research you did, you believe that this company is a $500 company. I don't know. This is $500. The stock should be selling for $500 based off of your research and everything that you did. But sometimes, right, when you do those, you need to understand this too. When you do your research into companies, right, and you come up with your theory and what you believe the price, the true value of the company should be, it doesn't matter, because the market is really about narrative, really, a lot of times, right? Because you will have companies like SpaceX, right? Companies like SpaceX. You got company. Sorry, this is Virgin Galactic. Don't want to confuse SpaceX with Virgin Galactic. But you have companies like SpaceX, right? You got companies like SpaceX that are valued at $1 trillion, right? $1 trillion market cap, when they own, even though they have great earnings, right? They had great earnings, revenue wise, but still not generated any cash. And people will tell you this is a company that you should pay $1 trillion, maybe $2 trillion if you bought it up here. But this is a company that you should be buying. I just disagree. But I understand that the market doesn't, the market isn't always rational, right? It isn't always rational. Sometimes you have bad companies. Sometimes the market is just willing to, pay a premium for, dreams, right? For the moment, until they don't believe. Right now they don't believe that Adobe is going to be a company that's going to be present. They believe that AI is going to be killed. AI is going to kill, software stocks. That's why a lot of these software stocks are being killed. SpaceX is at $1 trillion because they believe in whatever Elon Musk is telling them, right? I really don't know what the dream is. I don't care about the dream. I care about the how much cash you're generating, what are your margins are going to be, right? And I'll make a video of how, what's the best way to kind of like to research individual companies. Like the reason why Nvidia is the most valuable company in the world is because they're projected to grow their revenue, right? They're going to surpass, I think they're going to surpass Microsoft, Google. They're going to get, they're going to surpass, they might even surpass Amazon. They're projected to grow, right? For the next 10 years, and their revenue is already at, I think in the last trillion, 12 months, I think it has to be close to 300 billion, right? They're 300 billion, right? Close to 300 billion in revenue, right? And their net margins are ridiculous. Like the net margins, the net margins are like 50%. It's ridiculous. Operating margins at 60%, right? It's ridiculous. Like I don't know. There's not many companies out there, right? There's not many companies, right? Off of their sole business, right? Not selling a part of a business, like their whole business, right? They're making right now 50% of whatever revenue, right? It's just crazy. Like they're just killing it, right? They're killing it, man. They're just killing it, right? That's the reason why, and the reason why this will continue to grow is because the market doesn't see them slowing down anytime soon. I'm telling you, the next 10 years, their revenue is gonna grow maybe 25%. That's ridiculous. Just imagine this. Imagine if you had $100,000, right? And put in your calculator, do the calculations. If you had 100,000, right? And you grew that 100,000 for 25% for the next 10 years, man, you'll be one of the greatest investors of all time. If we could do some stuff like that. But Nvidia is a great company though. This is a great company. And we might see like right here, like I think right here, I bought it down here. The reason why, anytime, right, you need to understand that's the risk of the individual companies. You might be like, okay, man, why did it do this if it's such a great company? Easy. The narrative, I think this, when it dropped, it was during the tariff war too. So, whatever tariffs thing could affect their businesses had them going down. And I think they had that moment when Deep Seek that came out, and everybody was just thinking like, yeah, they were just thinking like, yeah, something's going on. I forgot what it was, man, but it was like, oh, everybody's investing all these billions of dollars into these GPUs, and China just did their own AI cheaper, so it made this stock drop. But it was just a great opportunity to buy. But those are the risks. That's just a little risk that you run to with buying individual company. That's why I believe you should only do anywhere from 20%. 20%. That's what I do. I do 20%, and 80% goes into my my ETFs. But I'm gonna do a little video with you guys sometime this week, basically talking about how you start your research of an individual company. I would do it now, but we're already at 19 minutes, and I don't want to make these videos too long for you guys. But yeah, anytime you guys are in a bear market, you should be investing like that, man. Anytime you find yourself wondering, damn, okay, I want to get into ETFs, right? I want to invest in ETFs. Why is it not moving? Okay. Well, anytime you guys want to get into ETFs, just do that. Just do that strategy. I promise you won't fail. That's what a lot of people do. But a lot of people want to do the fast money thing. Fast money, it's gonna put a lot of stress on you. Easy money. I just gave you a strategy that's gonna make you a millionaire if you just do that. You just buy the market when it's down 5%, 10%, 20%, 25, 15%. You do those things on any of those indices that we talked about. SPY, the Dow, the Russell, the NASDAQ. You do that, and I promise you, you could, like I said, go, you could test it. Go back, go back to 2010 and implement that strategy. You know, okay, give yourself 100,000, give yourself 10,000, and implement the strategy. Be like, okay, if I bought here at 5% here, then I bought here at 10%, then I bought here at 15%. Okay, if I did 10, 15% of my portfolio, 20, hey, I was 75% invested at these times, what will be my returns? And if I continue to add on that while the stock market continue to go up, what if I just continue to invest at those levels at 5, 10, 15, 25, 20? There's, you know, do it for yourself and see what your returns could have been, and bring yourself up to the present. But I'm gonna leave it at that. I just hit over 21 minutes. Sorry for the long video, guys, but I just feel like this is really good information, and it's really hard to find this type of information. Everybody's out there trying to sell you a course when you could do all of this stuff for free. The charts are free. You could go look at all these companies' revenues from a very long, man, over 10 years. You don't need to pay for nothing. This is all free. But I'll catch you guys on the next one. Be blessed. And hey, are you a recruiter?